This is my report setting out the financial situation in the municipality of Bergstadt Klausthal-Zellerfeld in Germany. I hope you find it useful and it assists in future decision making for the city. I note that your financial statements are based on accrual accounting, meaning expenses and revenues are recognised when they are earned and incurred, respectively, not when cash is received or paid. Firstly, the income statement, which compares budgeted and actual figures from 2014 and provides an assessment of how the city performed against its financial plan. It also includes actual figures from 2013 to enable a comparison over the 2 years. The 2013 income statement shows a deficit, or expenses exceeding income, of $3 million. This would explain why your predecessor presented a budget for 2014 which aims to show a surplus of $3 million. This financial plan proved too ambitious, as the accounts for 2014 also show a deficit. Specifically, the income statement shows actual revenue for 2014 of $3 million, or 7.3% less than forecasted, including $1 million lower revenue from taxes, restricted grants and fees and tariffs than forecasted. Actual expenses were $2 million, or 5.3% higher than anticipated, as a result of higher salary costs than forecasted. Salary costs, one of the most significant costs for the city, as with most public sector organisations, were forecasted to decrease by $3 million, but only increased by $1 million. Nevertheless, this was still a step in the right direction. All other expenses were as forecasted, which is good. Overall, the city's income statement shows a $2 million deficit, which was $5 million less than forecasted, however a 33% improvement from the $3 million deficit in 2013. The cash flow statement shows actual incoming and outgoing cash flow figures over the year for operating and investments and financing. Operating cash flows include revenue from taxes, fees and tariffs and grants, as well as operational expenditures including interest on debts of $3 million, which is significantly 5.5% of the total debt of $55 million. The city had an operating cash surplus of $6 million and an investing and financing cash deficit of $8 million, resulting in an overall cash flow deficit of $2 million. Lastly, the balance sheet, which presents an overview of assets and sources of finance at the end of both 2013 and 14. It is showing a reduction in fixed assets, which are predominantly tangible assets, such as buildings and equipment like IT and vehicles, of $6 million from 2013. In addition, current assets, or assets which can be converted into cash at short notice, have reduced by $2 million. In total, there has been an $8 million reduction in assets. Total liabilities have reduced by $6 million from 2013. Equity, or the value of assets minus the value of liabilities, is $20 million, which is a reduction of $2 million from 2013. There is an $8 million reduction in total finances from $83 million to $75 million. Ratios are a good way of assessing the financial health of the city. Solvency is the extent to which the city is able to pay off its liabilities in the long run to avoid bankruptcy, and can be calculated from the total equity divided by the sources of finances. The city's ratio is 0.27, or in effect, equity covers 27% of the total source of finances. To put it another way, if the value of the city's assets were to drop by 27%, all debtors could be paid. Future losses can be covered by equity up to $20 million, the total amount of equity. This is a good solvency position for a public sector organisation such as the city, with a low risk profile, as it sits under a central government. The solvency ratio has not changed from 2013. Liquidity is the extent to which the city can pay for its short-term debts by means of its current assets, or the ratio of current assets and short-term liabilities. Ideally, this should be greater than 1. The city is in a good position because its short-term assets are 25% higher than short-term liabilities. It is worth noting that the bank and cash component of the city's current assets, the most liquid part of the current assets, is quite low, $10 million. The ratio based on just bank and cash balances is 50%. Therefore, available cash can only cover half of the short-term debt. As city manager, you need to be confident you can collect the city's accounts receivable quickly if you're to ensure it has enough cash to pay off its short-term liabilities. The city's liquidity of 1.25 has reduced from 1.29 in 2013, which isn't good. It isn't a good trend. Financial performance is the extent the city can cover its costs by means of its revenues, or the ratio of revenue over cost. It is ideally greater than 1. The city's ratio is 0.95, which isn't good and indicates the city cannot cover the cost of its expenses. This may not be a serious problem this year as profits and losses change over time, but if the city had a deficit over consecutive years, it will be in trouble as equity gets eaten away. The city's financial performance in 2013 was 0.93, which, although indicating a slight improvement in 2014, is still not good. The city is unlikely to become bankrupt, but it may get dictated to by the central government, concerned about continuous losses and lack of equity, and banks will require higher interest rates or more restrictive borrowing conditions due to the higher level of risk. This low financial performance needs to be addressed. The financial performance ratio in the 2014 forecasted budget was 1.08, which proved to be too ambitious. The 2015 budget could aim for a more modest improvement, or alternatively look at more significant changes to budget lines which can create revenue or reduce cost. I would suggest this would be a preferred approach to get the city back into surplus, which can be used to bring down some of its debt, which has high interest costs. Changes could include freezing salaries for a period, a large expense for the city, or investigating increasing taxes and fees and tariffs. Increases in taxes can create a social and political impact, and the city needs to ensure that the socially disadvantaged are not further disadvantaged.